Going to talk today about the future of trading. My name is Balaji Srinivasan, at Balaji on Twitter. I know seemingly like half the people in this room, which is great. Formerly CTO of Coinbase and GP at A16Z. And I want to let the folks here introduce themselves. So you want to go first?
Thank you. So I'm Florian from Fundament. Fundament has made quite the news recently because we've launched the first fully unrestricted security token on the public Ethereum network. It represents a real estate bond. We're issuing 250 million of them, and it's based on the ERC20 standard. It's a vanilla ERC20 token contract, and we figured out a recipe where we get full approval to do such an issuance by the German Financial Market Authority, enabling us to sell this to any investor worldwide with a minimum investment of €1, and we plan to apply this recipe to many more assets like private equity, VC, shipping, and all things, always based on a fund structure. That's what we do, Fundament. Thank you.
Will?
So I'm Will, I'm the CEO of DeversiFi, which is a decentralized exchange. Formerly, I was working at Bitfinex and then launched ETHFinex as a hybrid centralized, decentralized exchange. And we announced about a month ago that we decided it was time to close down the centralized side of ETHFinex and spin out and focus only on decentralized exchanges, given where we see the position of the technology now being and what's going to come in the next year or 2 years. And DeversiFi now will be focusing on figuring out reducing costs and scaling decentralized exchange, starting from the existing platform that we're operating and then launching also several new platforms.
And Bartek, yeah.
And I'm Bartek Kiepuszewski from MakerDAO. I'm a product owner for the Oasis DEX trading protocol, I'd say. It's a decentralized exchange that today, I'd say that it's by far the biggest liquidity pool on ETH-DAI market, which powers DeFi. And ETH-DAI, it's the major front end for that's actually using Oasis DEX protocol. And I would consider Oasis DEX as part of a larger MakerDAO ecosystem, alongside things like oracles and Keeper network and a couple of other components, which sort of are actually necessary for the core protocol to run properly.
Awesome. All right. So we're going to go through just a few questions here. So why don't we'll just go kind of in order. So Florian, where do you see crypto exchanges in 1 year and 5 years? What's your vision for the near and medium-term future?
So I think crypto exchanges will, in general, become more and more commonplace for a more and more mainstream audience. Since we issue security token, it's kind of a new crypto asset, and there are currently no regulated centralized exchanges for these assets, so effectively they cannot be traded. So we are actually building on decentralized exchanges to fill this gap until there is a regulated venue. And the hope is really that in this time frame, which could be up to a year, decentralized exchanges will get so good that maybe we won't even need the really centralized versions of it anymore.
Interesting. Will?
So I would say we really see that. I think decentralized exchanges are starting, have proved the concept. It's now clear that we will have better exchanges coming out of the technology that's being built here, and actually not just for cryptocurrencies, but for settlement of all sorts of assets and the kind of developments that are happening here. And I think, as Avahu was saying, we'll build better exchanges and better settlement layers eventually for trading traditional assets. I think in the short term, let's say the next year, I mean, the reality is that except for niche types of arbitrage, I think most decentralized exchanges aren't going to become mainstream. They're not able to offer the experience that you'd need to ever compete with centralized cryptocurrencies exchanges, and certainly not outside of this industry. But that will change very fast because it's now essentially a cost problem rather than a proof of technology problem, and that will mean that over the next 5 years, I think we will see fundamentally decentralized exchanges start to take over, and the reason for that being that they offer, or they can offer, open access in a way that existing alternatives can't. So because you don't need to trust everyone who's in your network, you can have a much bigger network of participants directly accessing into an exchange, and therefore ultimately better liquidity network effects and lower costs. And so I think that will be a very, very long, at least a 3 or 4 year journey, but that's where we consider it will go.
And Bartek, what do you think?
I have to admit that, in my opinion, we as a community are not that great at making predictions. I mean, we failed so many times right before. But having said that, I can only say what I do hope for, and I do hope that every single exchange that we will be using in a few years' time will be non-custodial. I think this is like crucial. It's beyond me why people are still using custodial exchanges, given so many of them, just continue to vanish in the thin air. I spend most of my time in Poland, and the Polish crypto community has been shocked by the sudden disappearance of one of the biggest centralized crypto exchange in Poland with the longest history, and the owner of that exchange was actually found dead in the forest, and frankly, I have very bad feelings for the reaction of the Polish regulator because of that. I mean, they have no idea what's going on in crypto, but they would sort of try to put everyone into the same basket, right? And we, as a community, should be smarter. So that's one thing, and then again, I think trading, there are a lot of different use cases, and I think that there will be a lot of different architectures, and there will be no one winner. And this is essentially what we've witnessed with Oasis, given this Cambrian explosion, not of just zero knowledge proofs, but also on the DeFi in the last few months. We've been kind of pleasantly surprised that this explosion actually brought a huge volume to our exchange, in spite of the fact that it's fully on-chain, it's slow, it's been criticized by so many, and yet it's still somehow a preferred choice for people who just want the features that you get when you trade on chain. And clearly, I mean, this is not about scalability or privacy. I mean, this is really for DeFi protocols that require composability, right? So if you do margin trading using Compound or whatnot, or DYDX, I mean, this is what they use today.
Well, let me actually, so you guys brought up a few points up. Maybe I can push on this a little bit. So, a while ago, one of the theses on decentralized exchanges was that they were going to offer some form of regulatory arbitrage. You were going to be able to list everything that you can list on a centralized exchange, and you could, just trade whatever, and like the state couldn't do anything or whatever. And that really it's kind of played out, but really hasn't fully played out because the liquidity isn't there. And so a new thesis, which I've heard two of you talk about, and Florian, you may think about as well, is that it's that the advantage is non-custodial. And one kind of macro thesis I have on the whole space is, come for the money, stay for the freedom. So people come for the upside of crypto, and then they stay because the philosophy or the programmability or something like that, draws them in and keeps them. And so, with respect to that, with non-custodial trading on a DEX, you could keep your funds locally and then arbitrage multiple exchanges, and that actually gives you money. And then you keep it non-custodially because it actually makes you more money, but it's also something that long-term keeps your coin safe. So that's like one way that it might get adopted. What do you think about something like that?
I mean, I think that's absolutely the case now, certainly. So, for example, talking about ETH2DAI, the reason I think why a lot of people would use that is not because it's decentralized at the moment. It's because if you are generating DAI from using MakerDAO, it's faster to trade it to ETH. Using that much faster than depositing to an exchange, a centralized exchange, waiting 20 minutes for it to be credited, making your trade, then withdrawing back to your wallet. And so that there's already a speed advantage there, which translates effectively to a cost advantage as well if you're worried about losing an arbitrage opportunity. And so ultimately, I think we have to consider that, particularly in this design space, but I think obviously in a lot of applications, traders are one of the most economically rational entities as close to it as you can get, and so they do look at the ultimately at things in cost sense, and so yes, using a centralized cryptocurrency exchange, maybe even if there's a 5% chance that it's going to get hacked and lose funds, or that it could be facing other sort of regulatory pressures, that currently could be a higher cost than doing everything on chain and paying lots of fees and losing opportunities which you'd otherwise get from using a faster off-chain exchange. But in the case of arbitrage at the moment already, we're seeing the speed advantage being the primary driver.
Yep. So price arbitrage rather than regulatory arbitrage, which is interesting. Go ahead, Florian.
Yeah, I want to jump in here because I think the reason this regulatory arbitrage didn't play out for lack of liquidity was because there were good enough alternatives, or better alternatives actually. And when it comes to security token, which have been talked about for years but never really were there for a number of reasons, but which are now starting to be there, there is actually this opportunity for the arbitrage and a lack of better alternatives because there are no regulated centralized trading venues for these types of crypto assets, and you actually need decentralized exchanges right now to get any liquidity at all for these token. And we've a week ago we've installed our token smart contract on the Ethereum blockchain. It's now there. We've started issuing some of these tokens, and people are starting to do secondary market transactions, and there's no other way than a DEX to do this. And indeed, if you want to do this arbitrage in terms of the regulatory arbitrage, then the question is, what is a DEX, right? When is it decentralized enough to actually fall into this loophole that in Europe is really the loophole of a bulletin board, where if you're not running a centralized order book, you're essentially not an MTF, and thereby unregulated. And I think there are DEXs that call themselves DEXs that still have some sort of a centralized order book, and then there are DEXs that are actually truly decentralized, like the Dutch X, for example. And I think at least these types of venues will see a big popularity among security token holders that want liquidity.
Well, yeah, that's interesting. So, Florian, one thing we were talking about off stage is sort of like an algebra of regulation. If you take A, B, C, and D and you combine them together, your regulatory burden is basically the maximum of A, B, C, and D often. So if you take a highly regulated security token, for example, and then you put it on an unregulated DEX, the state still has a hook in you from A, right? So how do you think about that?
It's certainly true, and I think we will have to see this in the wild, how it plays out, which jurisdiction claims some form of right to intervene in this. In our case, we're regulated in Germany and in a wider context in Europe, and there are very clear rules around what is a trading venue, when do you have to be regulated, what is a security token, what are the KYC, AML requirements. And we believe that if our token were to be traded on a DEX in Europe, that falls under this exception of the bulletin board put up by ESMA, then I think no state, at least in Europe, would intervene. If then American token holders would trade on these venues, obviously it's a different story, and we just don't know what the SEC would do.
Interesting. Bartek, you're saying?
I think you all folks should pay a lot of attention to what Florian and his colleagues has done, because I think it's a kind of revolutionary in terms of the topic that we're discussing. I frankly was very skeptical. I didn't know it was even possible. But right now it seems like the token is in the wild. And well,
I think you have one.
Well, you shouldn't have said that, but now everyone knows that I have one. And now we come back to the question, what does it even mean to trade this token? I can send this token to any one of you, and you will have it. You will be tainted with the security token, right? And you wouldn't even know that it's a security token just by looking at it, because it's just a pure plain vanilla ERC20 Open Zeppelin library created token. Not only can be traded at Uniswap or EasyStacks, any other exchange that essentially is permissionless, but it can be easily transferred among anyone, really, by Ethereum network, right? So how do you stop that? That's my question to anyone who thinks that this should be regulated. I mean, should we regulate token transfers on Ethereum? Should we regulate Ether transfers on Ethereum?
Well, so here's I'm just jump in like the referee grabbing a chair and jumping into the middle of WWF. So my thesis on this, for what it's worth, is that I'm obviously rooting for you guys on security tokens. I'm actually kind of bearish on it because redemption of that token for the actual underlying security is like a little bit of a hot potato. You know, you send to somebody, can they actually redeem it? An alternative is actually to take what you guys have done, Bartek, at MakerDAO, and you know, you've piped in the USD ETH price, and from that you've been able to basically get DAI like a stable coin. In theory, you could pipe in not the USD ETH price, but let's say the Goog ETH price or the Tesla ETH price, and essentially set up like a CFD, a contract for difference like thing, where you could get the benefit of any publicly traded stock without actually having the redemption issues associated with the security token, right? And I think that's like a more organic, like true to crypto way, because it's hard to ban a price signal. Now, I mentioned CFD. CFDs are highly regulated in the US, but not everywhere, right? And so it feels like an approach like that kind of takes away the redemption risk in a clever way might be feasible. What do you guys think about that?
Yeah, what you've just described, you know, I think these are the things that we will see, you know, in very near future once our system is more mature. I mean, in a few months we're going to launch multi-collateral DAI, and we'll be hoping that the community will come out and sort of provide us with different tokens that will be used to actually as a collateral for DAI. So that's sure. I mean, that's something that we will see next year for sure, you know, and I do hope that, you know, there will be another Cambrian explosion of different token schemes that will actually play out like you've just described. But just one extra remark. I think what you've said about, you know, bulletin board versus a trading venue that does the order book matching, that's kind of a divide that, in my view, is kind of flawed, because I mean, look at Oasis DAX. It's got order book, it's got matching engine, and yet I would argue that it's a protocol because it does not have an operator, right? And I think that divide that Martin showed on one of the presentations, you know, the exchanges that require an operator versus the exchanges that don't require an operator, that's a huge divide, and that's the divide that will play out to have an important role in future discussions, because the regulators will eventually come to realize that if there's no operator, then the only thing that they can do is to sort of, I don't know, put developers to jail, and I don't think that's gonna happen.
Well, it's interesting you say that, because I think, you know, I tweeted this a while back that pseudonymity is as important as decentralization, because decentralization, you can't get the network, but if the founder is not pseudonymous, well, they kind of know who it is. Like, you know, even if Facebook had released Libra, like totally open source or whatever, well, they know they're in Menlo Park, they know where to reach them, and so on. So it may be that the higher the risk, you know, you're taking, you might want to do something pseudonymous. Let me switch topics here. What are the major innovations in trading that you've seen, and what things do you think are important? Will, let me bring you in since you haven't.
Yeah, so I think probably the biggest thing that's happened in the last year or so, and I think which will continue to grow, is the kind of movement around leverage in the DeFi space, and that's something which is required for large scale speculation in the sense that it will empower growth of liquidity, but also prices being driven through decentralized exchange networks rather than just following. In the sense that I think what you're describing earlier with synthetics, that would work for large shares like Google, which are where you're following the price. But if it's a new token that's issuing a new security for the first time, there may not be a clear price signal, and so you do need a different form of trading to happen. So I think that's the first thing. But then secondly, different scaling techniques to reduce the cost of settlement. I think that will be the next stage. And those two things combined, I think, will mean that this can really start to compete.
Excellent. Florian, what do you think?
Obviously, my perspective is biased from what we do, but for me, the biggest innovation is how, for example, the Dutch X, but also Maker, come up with exchanges that are really protocols without an operator, because this is where this divide is in the regulation. And so I think this is super innovative, at least for people that are interested in the security token.
From my perspective, we're gonna follow both routes. To be clear, we think that there's space for a protocol which is fully decentralized, and there's space for an operator-run exchange. And obviously, for the second case, ZK rollups and zero-knowledge proofs providing scalability and privacy, are crucial. And I mean, the architecture that you have just seen before this panel, that's I'm very bullish on this. Having said that, I do hope that we're going to find a sweet spot between the privacy and actually transparency of the actual volumes traded, and so that everyone can be assured that we're talking real volumes and not wash trades or some tokens that no one's ever heard of, which is, I mean, we know that this is a problem with crypto trading, obviously, and but also decentralized exchanges and our community here. I mean, we should be like more vigilant. I mean, I'd like to really understand, for example, IDEX volumes, and I'd like to talk to someone who can provide me with the real data from IDEX, because I'm seriously personally fed up seeing IDEX as the #1 exchange.
Yeah, it's funny you say that, because basically the value of being ranked as a top-end coin is much higher often than the fees that you would pay to wash trade and fake it or what have you. And I often think of CoinMarketCap as sort of being like, with no offense to CoinMarketCap, it's a great thing and so on, but sort of like the Alta Vista Digital of like coin rankings, right? Where Alta Vista Digital, if for the folks who are too young here to remember that, was a search engine that was subject to keyword stuffing. And because of that, any individual page could get up there. And then you needed a new algorithm, like Google-style PageRank, which was robust to keyword stuffing because it had backlinks that any individual coin couldn't fake. So something like that, where you have things where you can't fake it. This gets us into the topic of sort of trustworthy exchange analytics or data. Right now, the heuristic people use is these exchanges are trusted and these aren't. So you just exclude all of their data and you just include all of these. And that's actually a reasonable first cut, but maybe you have ideas on something better than that.
For our statistics, we actually do deep blockchain trace analysis. We're trying to find out what are the sources of transactions. So I'm kind of assuming that if the transaction is a part of the broader DeFi ecosystem, comes from Compound, DYDX and whatnot, or from Trusted Wallet, that's a legitimate use case, because that's not just, a transfer of tokens from one account to another. But it's a tough problem, right? How do you actually classify these? But this is essentially our approach.
You get to a good issue there, which is the transparency versus privacy trade-off, because before you trade, you want to have a glass box and know everything about it. But your particular trade, you actually don't necessarily want everybody to know about it. So you have different incentives in different parts. Okay, so moving to another one. So what do you guys think of as the best jurisdiction to do crypto trading, to set up an exchange? Let me start, Florian, go through.
I would definitely place it in the European Union for a number of reasons. I don't think it's that smart to go offshore in the long term, especially if you want to get more and more reputable players into the space. So having
anywhere in the EU or Switzerland or?
So the good thing about the EU is that it is uniformly regulated by MiFID II. So it doesn't really matter specifically where you do it in the EU. You would then look at the availability of a how good are the legal institutions in the country? Is there a court system and everything, right? I wouldn't go to Switzerland simply because they are not part of the EEA. In particular now Germany is interesting because they are pushing for security token regulation on all aspects. I think they want to be kind of a first mover there, but ultimately it's really about the European framework that is harmonized in a huge market and provides, unlike, for example, the US, some very clear rules on how things work, which reduces legal cost by an order of 10 or more. And so, yeah, I would be voting for the EU there.
Will?
So I think it's a difficult decision to take for any exchange that's launching, particularly now. But I think actually, although MiFID, of course, it gives you all the advantages you give there. And actually, I think in terms of primary issuance, it maybe makes sense in Europe. But there are a lot of disadvantages to trying to fit something that's different into an existing very sort of solid regulatory standard, which wasn't designed for these sorts of things. So I think somewhere like Abu Dhabi is one of the most interesting. So it's based on UK law, but they actually have made very specific provisions, for example, for self-custody, managed custody of assets, and that changes the way that the treatment of the exchange is done, both for settlement and if you have a centralized operator. And there are various others, I think, which are following that model of actually designing it from the ground up for cryptocurrency exchanges and take into account all these different challenges. And I think that will probably be the first landing point, and then hopefully, I think maybe later on, Europe, for example.
Are you located in Dubai, or?
So at the moment, we are located in British Virgin Islands, so offshore. I think that's, to be honest, the only way. I mean, if you genuinely want to be operating a cryptocurrency exchange, there's a huge cost associated with doing it anywhere that's sort of an onshore, like UK or even Switzerland. But in the long term, that's the most interesting direction, is places like Abu Dhabi.
Bartek?
I guess I would say that it all depends on the use case and your own definition of cryptocurrency, right? Because everything's to us is like a token. It can represent what we think it's a currency, but it can be a security token, and of course there's this huge gray area in between of tokens that some would say that it's a security token, some wouldn't. But normally I would definitely prefer jurisdictions that are trying to recognize that you're actually trying to change the world for the better, rather than put you into this, broad basket of people doing cryptocurrency scams. So what we're doing with our exchange, we're actually trying to make sure that indeed our understanding of a protocol which is not operated, this is a good understanding, in many jurisdictions, and I think we try to actually talk to as many jurisdictions as possible to make sure that there's nobody that will sort of challenge this point of view. And at the same time, for the parts that we do operate, I think it really depends on the use case. So we will approach Americans to register ATS, for example, because we do want to trade security tokens for American customers, and that's the only way you can do it. In Europe, we probably might actually do it in Switzerland because the Switzerland is far more advanced in terms of their thinking, and they've got special provisions, right? Again, for DLT trading, whereas European Union, the MTF concept is not really designed to use for blockchain. The GDPR is not designed to be used for blockchain, and so forth, right? So it's actually harder, and Switzerland has this advantage that they're very progressive, and at the same time they located right in the center of Europe. So whatever we do in Switzerland should be actually usable for users, not just from Switzerland, right? But in broader area.
I'm surprised none of you said, so basically I heard Europe, I heard Dubai, I heard quasi-Europe, is that right? Like.
Yes, Switzerland also, we're talking with Liechtenstein lawyers, for example, right?
Okay.
And like I said, I mean, I think it depends on the use case. So let me just give you an example. So if you wanted to have some sort of a pro version of margin trading where it wouldn't be fully decentralized, but we would actually borrow, as an institution would borrow you as a trader money, then we would certainly use the jurisdictions that will make it easy for us, right?
Okay. So I heard, okay, so summary, Europe, BVI, Dubai, Liechtenstein, and so on. I would give a shout out probably for Singapore, which I think is a good all-around jurisdiction for a lot of people. There's probably Asian jurisdictions that folks might be able to educate us on. So just last minute that we've got, just quick lightning, 30 seconds. What's the next big thing in crypto trading?
I guess I'm like a broken record that repeats itself. So I would say it's security token. We will see, I think, a lot of tokens being issued over the next 2 years, and people will be looking for liquidity. So whichever trading venue, be it fully decentralized or totally centralized, can make it possible for the biggest number of users to get liquidity there, will be a very, very strong contender for a, I think, super massive, super successful company in the future.
Will.
So I think it will be scaling via two routes, but I think the primary one that will eventually win out will be things like Starks for batch settlement, which will just reduce cost and mean that these do become practical for very high frequency trading, which then means that they can also lead price discovery.
With the multi-collateral DAI launch, you'll be able to self-leverage yourself without any counterparty. So that will be huge, we hope, and I definitely encourage every one of you to check it out because it's going to be a very different experience from using someone else's funds. Like you would do with Compound and whatnot, and also what these guys did. I mean, it's ingenious. I mean, I'm very much looking forward to see how that's gonna play out, because that can actually radically change how we think about security tokens and security token trading.
Great, thank you all very much.